Welcome back, beautiful people. You're listening to A Moment of Zen right here on 710 WOR, the voice of New York. I'm your host, Zen Sams. Now, up next in our Business and Buzz segment, we have returning contributor Kyle Wool, president of wealth management at Revere Securities. And today we are chatting about 2022 trends, what to pay attention to in the market, and one hot ETF to look out for. As a new group of underserved customers enter the investment space, here we are. Women in the US are expected to control as much as 30 trillion in assets over the next 3 to 5 years, and millennials 20 trillion by 2030. The new decision makers will expect the industry to offer unique investments and structured finance tools and options that our grandparents simply did not have access to. Women and millennials tend to invest differently than the past generation of older men. Millennials are both more risk averse and more socially conscious when selecting investments. In addition, because we came of an age during the financial crisis, millennials have a negative perception of some of the more traditionally dominant financial services companies. But here to break it all down for us is Kyle Wool, along with Bobby Dudley, who was on the original Sector SPDR team in 1998 when they brought Sector SPDR to market. He rejoined Sector SPDR in 2008 and is currently the Eastern Division Manager as well as the NYC Metro Sales Manager. They currently have approximately $250 billion in assets under management. He is definitely no stranger to the game. Welcome to the show, gentlemen.
Thank you.
Thank you.
Kyle, so nice to have you back. Let's start with you. As many are grappling with the challenges of too much, right? We have too much demand for consumer goods, tangling supply chains and stocking inflation, too much money sloshing around in Silicon Valley and on Wall Street, making startups and stocks look overvalued. And on a far more sober note, too much carbon dioxide in the atmosphere, posing difficult choices about sustainability for CEOs, investors, and consumers alike. So no surprise then that you, Kyle, are on the hunt for companies that have the business models and the technology to adapt to this very fast-changing world. What investment vehicles are you looking at these days?
Well, everything's dependent on the individual investor and what their risk tolerance is. But I do think right now we're seeing a rotation in the global markets. You're seeing a lot of the high-flying technology stocks that have done tremendous throughout 2021 and even 2020 during the COVID crisis that never seems to quite go away. But you're seeing companies like Tesla, Amazon, and Apple that have done very well. I think people are taking some end-of-the-year profit taking, especially with the year-end for tax purposes. And you're seeing some rotation going into more traditional brick and mortar stores, more traditional industrial plays. Whether the Build Back Better comes back in a different form or not, it seems that not a lot happened with that over the weekend, but you're starting to see some money rotate out of tech into more industrial plays. And that's one thing I've seen on a macro level.
Yeah, absolutely. And companies, and these are very shifting times, and you have to look at these companies and really look under the hood. Bobby, competition among ETF issuers has resulted in the introduction of ETFs that are very specific in focus. So young investors can find specific ETFs that track particular markets or segments that may be particularly appealing to them. And as of 2020, there were at least 2,177 US-based exchange-traded funds, according to data from Fidelity. For young investors, this extensive range of available ETFs offers such a wide range of investment choices. Talk to us about SPDR's ETF in particular and what you guys are doing over there.
At Select Sector SPDRs, what we have is 11 sectors basically that are all part of or components of the S&P 500 itself. So as opposed to buying one ETF that represents the entire S&P 500, you can customize and weight each sector according, as Kyle had talked about earlier, about the risk tolerance of a particular client. In addition to that, there are certain things that you can do with sectors. For example, the current environment that we're in has raised the bar in terms of hybrid work environments. So you work partially from the office, partially from home. Technology can't be abandoned because technology is a big driver of software that has to be utilized in those type of environments. And on the flip side, there are other things where energy and sustainability has changed. In the energy sector, which is dominated by the oil companies have changed, where they're looking at carbon changes where they can actually recapture and also become much more sustainable. So there's a lot of different varieties out there. And again, technology has probably been one of the bigger stories in the last couple of years. And at the same time, a lot of analysts will look, or strategists will look at different scenarios based upon what the Federal Reserve is doing, and therefore look at sectors, for example, that would have a play against inflation, and in other situations against rising interest rates or the potential for rising interest rates. So a lot of sectors, for example, that would be defensive, things like consumer staples, which are mostly food and beverage type of companies. And then you have things like healthcare, everything from large cap pharmaceutical companies to biotech companies. And then energy again, and probably real estate is probably one that is often looked upon as a inflation hedge. As real estate prices rise, it's not just what we see here in, let's say, for example, in New York City, but nationwide in different areas such as tower stocks, those companies that are involved in cell phone companies, all the way down to companies that are in the storage business. So it's very different world, but you can customize, and that's really the key.
And customization is definitely lucrative to the younger pool of investors, I think.
Correct.
We always like to customize things. It's kind of like living in this digital world where everything's on demand and you want it and you can have it and it's instant gratification. Same thing with catering to what we need in terms of our financial necessities. Kyle, we've been through this incredible rebound year, but now we're starting to see new headwinds, whether it's inflation, labor and supply chain problems, or the end of government stimulus. Is 2022 a year when you see equities, value of shares issued by a company, when we talk about equities in general, cooling off?
Well, obviously the market's been red hot for the last couple of years. So even with a little bit of a pullback that we've had over the last week or week and a half, people still have to understand the S&P 500 is up in excess of 20%, even with this pullback. So 20% is a red hot market. Do we expect 2022 to be at 20%? We never really expect the markets to be 20% or 30% in any given year like they have the last few years. But I would say money is still cheap. If the Fed does start to taper, it's going to take a while. And I don't really see the real interest rates rising, especially with this new omnivirus.
Yes, and 2022 is just a week away. Kyle, I have another question for you. Young investors who are not altogether familiar with the intricacies of the financial markets might be well served by investing in an exchange traded fund that tracks the broader market versus sector funds that enable investors to take bullish or bearish positions in specific sectors. And characteristics of ETFs that make them ideal investment vehicles for young investors include diversification, liquidity, low fees, investment management choices, and innovation. Walk me through what you are looking for, a real pro's POV.
Yeah, I think if you're looking at what I do for my own investments or what I do for wealthy individuals, I think that 80% of, or 70 or 80%, depending on the person, should be in diversified portfolios, whether it's ETFs like Bob Dudley's talking about with the Select Sector SPDRs and large caps. But I also do think it's intelligent to take 10, 20, or even 30% of your portfolio and look for the next Tesla and look for the next Apple. I do think great wealth is created through concentration, but at the same time, a majority of your wealth should be preserved through diversification. And I do think the ETF, especially right now, whether it's RSPY, which is Revere Securities ETF, which is created out of the 11 sector SPDRs, I think that's a great way to protect your wealth. But I also do think it's important to start to look at some of these pre-IPOs like Impossible Foods or Reddit or Robinhood, where you can make a lot of money. So 2022, I think, will be a very tactical year. I do think you should be conservative with the bigger part of your portfolio. I do think you should look to rebalance, take some of your profits, but I do think money still will remain cheap and there's a lot of opportunity out there.
Got it. Got it. Good advice. Good advice. Noted, my friend. Well, listen, time is up. Thank you so much for coming on and chatting with me. It's always a pleasure. Bobby, thank you so much for coming on. That was Kyle Wool, president of wealth management at Revere Securities, and his friend Bob Dudley from Sector SPDR. You guys could check them out on the internet at www.sectorspdrs.com. You're listening to A Moment of Zen right here on 710 WR, the voice of New York. We'll be right back after this.